Welcome to Taking Stock for the week ending the 27th of August 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to you all things share market. So as the reporting season comes to a close, one thing we've noticed is that the US and Australian markets have continued to rise, and that's despite statewide lockdowns in Australia and another wave of COVID infections around the world. In fact, economists have been downgrading their September quarter economic growth figures, expecting GDP to contract by about 3 to 4%. Meanwhile, July retail sales figures have fallen by 5.6% month on month, with this trend expected to continue in August. And on the commodities front, there are signs the commodity market is rolling over as China puts a brake on iron ore. Yet the share market continues to hit new highs. And to understand this, you really need to look into the reporting season. There has been rising corporate confidence, and that's reflected by the return of capital to shareholders via share buybacks and special dividends. If businesses were concerned about these risks, they would rather be hoarding this capital to protect them from any economic downturn.
Yeah, and the other reason is that investors are looking forward, hoping that vaccination rates will continue to rise to prevent hospitalisation and deaths. Across the world, countries with high vaccination rates are less inclined to enforce strict lockdowns. At the current rate of vaccination, around 70% of Australian adults will be vaccinated by around mid-October. Lastly, investors are anticipating the economy to bounce back strongly, similar to what occurred in the last financial year, with government and central banks willing to add further stimulus if necessary. Interest rates remain low and depressed bond yields have helped lift the valuation for stocks. Hence, we remain positive on equity markets for the year ahead.
Yeah, thanks, Jake. Let's now turn our attention to the reporting season. There has been an abundance of star stock announcements this week. So we remind our investors to please refer to our commentary and ensure you have the alert triggers in place so you can receive our analysis in a timely manner. In the meantime, in this episode, we want to draw your attention to some of our star stock highlights. And at the start of the reporting season, we did speak about downside risks to these global fund managers with the underperformance of their funds and exposure to those regulatory risks in China. And last week, we told investors to be careful in holding Platinum Asset Management, especially after we removed Magellan Financial Group following the disappointing result. Although Platinum Asset Management released earnings that were slightly ahead of market expectations, the company continues to be weighed down by the underperformance of its international and Asian funds, which will put pressure on the funds under management. And in addition, you have the rise in staff expenses, which could weigh on earnings growth expectations, which is expected to decline by about 7%. Now, at these prices, the gross dividend yield at 9%, although it appears attractive, this is on the back of a rising payout ratio, which could lead to potential dividend cuts if its funds continue to underperform.
Yeah, that's right, Kien. And early in the financial year, we also spoke about the risks associated with resource stocks, specifically with regards to bulk commodities and iron ore. If you can recall, a comparison of the China credit cycle to commodity prices suggested there was a risk to commodity prices in the short to medium term. And this has obviously played out across the iron ore market with star miners like Rio Tinto, BHP, and Fortescue Metals all pulling back strongly in recent weeks. A stock in this sector we want to mention is Mount Gibson, MGX. The stock was previously a star growth stock because it met our quant metrics with return on invested capital at 25% and strong earnings quality. However, we've had to remove the stock from our star growth and star income portfolios because its return on invested capital dropped significantly to 14%. Meanwhile, its free cash flow turned negative, making us question the sustainability of its attractive forward gross dividend yield of circa 12%.
Yes, Jake, the removal of this stock so soon after we initiated coverage is a good case study for our investors. A stock that is both a star growth and star income stock should not be viewed as a high conviction recommendation. Remember, our star stock selection process is based on a quantitative model which ranks stock factors on their most recent reported performance. This does not mean that they are the highest quality stock within our space. In fact, Mount Gibson is a higher risk iron ore producer when compared to BHP and Rio Tinto because of its lower iron ore grades, higher production costs, and shorter mine life. Clients should always undertake thorough due diligence on a stock before making an investment because a quant process it does have limitations. It is often useful to understand the business profile, the management team, and the outlook and risks before you invest. And these are golden rules 3 and 7. And please speak to our team if you are unsure of the facts.
Yeah, and on the topic of star stock removals, we've had to say goodbye to Monadelphous MND, a provider of construction and maintenance services to the resources and infrastructure sectors. Even though the company is expected to post strong earnings growth from here, understanding the active risks within the business should be paramount before you invest in this company. The group has been a victim of supply chain constraints from COVID, including travel restrictions on labour and skill shortages. The high input costs have made it difficult for Monadelphous to improve on its low profit margins because fixed contracts were signed prior to COVID. The issue has also led to significant drop in free cash flow, which is now well below dividend payments. And as a result, we've had to remove the stock from both our growth and income universe.
Yes, Jake, and another company within this space is Seven Group Holdings, and that company provides large equipment for the mining sector, and it also has a 40% stake in Seven West Media as well, so it's got some exposure to media. The disappointing share price reaction to its result was due to a tempered outlook statement, with guidance for the WestTrac business to achieve low single-digit earnings growth compared to expectations for double-digit growth. In addition, you've got the company which had acquired 70% of Boral shares as well, and that's a building materials company following its off-market takeover in May. Now, Boral has alluded to a challenging market environment with brakes on construction work due to lockdowns, and this also resulted in a 9% decline on the Boral share price as well. Meanwhile, you've got Kerry Stokes. He's stepping down from the board, but will continue to work in an advisory capacity. Kerry continues to hold a significant stake in the business, while his son Ryan Stokes will continue to take the lead.
Yeah, and within the building and construction segment, unfortunately, we've also had to cease coverage on John's Lyng Group, a building restoration company, after they reported a 44% decline in operating cash flows due to timing delays around cash collection, despite the recognition of revenue. As they say, cash is king, and the weak cash flow led to a re-rating of the company's financial health from strong to marginal. In addition, elevated balance sheet ratios made it highly sensitive to these cash flow changes. Positively, the share price has gained over 90% since our initiation on the stock at $2.92 late last year.
Yes, Jake, and now moving towards the healthcare space, a long-standing star stock which has returned to growth is Nanosonics. The company sells microwave-sized devices called Trophon, which sterilizes ultrasound probes without the use of chemicals. Its share price has been weighed down over the last year due to the delay of its new product and limited hospital access due to COVID restrictions. However, signs of a recovery have emerged in the second half, with the company confident that it could meet market expectations for 20% plus sales growth in this financial year. Access to the hospitals has returned, while its full year consumables and service revenue rose 9%. Earnings growth should be sustained on the back of an uplift in the ultrasound market, while the company is investing more into product expansion. It expects to upgrade its Trophon EPR product to Trophon 2 and plans to launch a new endoscope decontamination device in 2023.
Long-standing investors should not be too concerned with its high valuation multiple, which is below its historical average. This multiple will quickly come down as earnings growth remains strong over the next few years. Despite issues plaguing the company over the last year, the stock has performed well for us since we initiated coverage in 2017 at a stock price of $3.14. And it's also good to see skin in the game, with the chairman continuing to hold a 6% stake in the company.
Yes, that's right, Jake. We always look for skin in the game for a lot of these smaller kind of players. Another stock that reacted positively to its result was Lavissa Holdings, a retailer of fast fashion jewelry. Over the last year, demand for the company's products had dropped significantly following the cancellation of social events and travel restrictions. But its recent result highlighted a strong recovery in sales, with comparable store sales rising by about 8% over the year. And this is accelerated in the first 8 weeks of the new financial year, with same store sales growth of 38%. In fact, Total sales are now up 56% for the financial year to date, and that's exceeding consensus full year 22 financial sales growth of 39%. Hence why the market was quite ecstatic about the result.
Yeah, but an active risk that Lovisa highlighted was the increased freight costs and high inventory provisioning, which led to some pressures on profit margins. And this is a similar theme which played out with supermarket operator Woolworths. Freight costs and commodity costs are also set to rise, pushing up prices, particularly for long life groceries, cooking oil, frozen food, and red meat. Positively, the company reported a rise in sales in July and August on the back of New South Wales and Victorian state lockdowns.
And of course, following the spin-off of Endeavour Group as well, Woolworths is now flush with cash, which prompted management to announce a $2 billion off-market share buyback as well. The company also increased its final dividend by 15%, suggesting a gross yield of close to 4%. The company is expected to go ex-dividend at the end of the month as well.
Yeah, and Kien, as we wrap up reporting season, there are a few companies set to report next week, including the likes of Fortescue, Ripe, Regis Resources, and Sandfire. And look, please refer to the corporate calendar to stay abreast of these company announcements. And also for trend-sensitive investors, Accent Group and Fortescue Metals both turned bearish on the SD Max, while NAB turned bullish. Meanwhile, Nanosonics triggered a re-entry on the SD30 TSR.
For Under the Microscope this week, we run our eyes over new star growth stock entrant Netwealth Group. The company is a platform services provider to the wealth management industry. Some Stock Doctor clients may remember our previous coverage of Netwealth about a year ago, and we had identified a couple of active risks which we thought could impede earnings growth. And this included lower pricing structure for their platform accounts and also the cessation of a cash arrangement with ANZ. Since that time, management have undertaken a strategic review on its operations with plans to invest its cash pool into higher returning assets such as bonds. In addition, the company continues to generate strong growth in funds under administration, and this should continue to support its earnings growth expectations for 15% in the coming 2 years.
Yeah, and a concern for investors is that management flagged an increase in headcount and development costs in a bid to build out its technology capabilities and cement market share. Although this could impact net profit margins, we don't see higher spend as a concern, as it is necessary for Netwealth to retain its market position with what remains a highly competitive wealth management industry. Another issue with this company was the recent share sale of $42 million from the Hine family. Sell downs by company insiders can often be a negative flag. However, we don't believe that the recent share sale by the Hine family is something to be concerned about. The family does still retain a 55% of total shares on issue and therefore has plenty of skin in the game.
And finally, some investors may be a little cautious about the company's elevated financial year 22 PE multiple of 61 times, but this level is consistent with its historical average. We believe the premium is warranted as Netwealth remains Australia's fastest growing superannuation and wealth platform provider, and this is exemplified by the ability to attract fund inflows and momentum behind its market share gain as well. Reporting season can represent both a period of opportunity and disappointment for investors. There is an old saying, watch the costs and the profits will take care of themselves. But when it comes time to managing the downside risk, many investors are at a loss. Hence the question this week is, how do you deal with a significant negative share price reaction? Well, studies in behavioral science indicates that investors feel the pain of a loss is more than double the joys of making a profit. Investors tend to hold on to losses, hoping stocks will recover. Unfortunately, with a diversified portfolio of stocks, it is practically near impossible to avoid having a few disappointments during the reporting season.
Yeah, that's right, Kien. And the best approach in dealing with this is to have risk management strategies in place. According to Nobel Prize laureate Harry Markowitz, diversification is the only free lunch in investing. By holding a well-balanced portfolio, you effectively reduce the impact to your overall portfolio if a significant loss does arise. You also need to be objective. For those that are trend sensitive, you can use one of our recommended technical indicators, the SD Max or the SD30 TSR, or one of your own to help you remove the stock if the stop loss is triggered. For those who are more fundamentally orientated, please refer to our commentary to understand the active risks and reason for retaining the stock or removing the stock. If a stock is not covered, then read the financial results. Does the stock still meet your growth or income objectives?
Yes, and remember, our decision to remove or retain a star stock is based on a quantitative approach. At the portfolio level, this approach has a track record of strong outperformance, but at the stock level, there will inevitably be losing trades. Crystallizing losses is a difficult part of the investment process, but don't hold on to a stock based on hope. Try to make your strategy as systematic as possible, thereby keeping your emotions at bay. Also, by exiting your underperforming stocks, you free up that capital so that you can reallocate that to other opportunities. Remember the cockroach theory. There are often more earnings downgrades following the first one, so it's better to be safe than sorry.
Yeah, and losses in the portfolio are a natural part of the process. As long as your winners significantly outperform your losses, the portfolio should perform well.
Well said, Jake, and thanks again for sharing your insights, especially as we wrap up the reporting season.
Thanks for having me on again, Kien.
So, as we approach this end of the reporting season, investors should take comfort in knowing there are positive market drivers in the coming year, such as the global reopening narrative, low interest rates, central bank stimulus, and strong earnings growth expectations. Use this to your advantage. Reassess your portfolio and remove stocks that have shown a deterioration in the fundamentals and reallocate the funds into new opportunities. And Stock Doctor has a raft of portfolio tools, including the Portfolio Optimizer, to help you look for opportunities and manage the rebalancing. And as always, feel free to contact us if you're unsure about the active risks. Have a happy, healthy, and prosperous week, everyone.